What up, our Resource Nation? I'm excited because I'm going to get right into my conversation with our good buddy Dave Savage, who's been on the show countless times. And I'm excited to get into a conversation that we hope is positive, but I'm sure it can evoke some emotion. Dave, you had a really interesting post, and I love that you started the conversation. I think it's a conversation that needs to be had, and there are some interesting comments in that, and I won't give it away. I'll let you kind of summarize the post that you had, and also kind of talk about like why you felt the need to have that conversation now. So first, thanks for being here, man. Love you. Love creating content with you, and I expect this to be a really good show as well.
Yeah, so it's a loan officer comp, and I have not talked about loan officer comp on social media or in a public forum, which a lot of leaders aren't. I do go to MBA annual. I go to a lot of executive lender conferences, and LO comps is always a topic. And then I know a lot of loan officers. I interview multiple loan officers every week. I go to all the big loan officer events, and it's a topic, but it's a different topic. It's almost like this adversarial topic, and I just felt like compelled to bring some constructive tension and really try to help have a constructive conversation with loan officers, because I love loan officers. I was a loan officer. We build technology to help loan officers be more efficient and effective. And I love lenders. While we have thousands of individual loan officers that use our technology, we have hundreds of big lenders with tens of thousands of loan officers that use our tech. So I do think it's getting to a head where everybody needs to get it right. And here's my last comment. The way I see it, like 2 years from now, the market is going to make you get it. And by the way, the market's already making people get it right. It's not productive. It's not healthy. It's not sustainable. And so I wanted to just start a conversation around it.
I want you to summarize, the video, because you shot a video, and we'll put a link to the video in the original post down below. But I want you to summarize. But Dave, when I saw that, I felt like it was impactful conversation for loan officers, lenders, and realtor compensations come under fire recently too. So I think it really applies across all spectrums, which is why I love the conversation. And I think, I won't speak for Dave, like we're having the conversation that can evoke emotion. We get that. Taking away compensation or reducing compensation on the realtor side, on the loan officer side. Our goal isn't to take any money out of anybody's pocket here at all. Conversely, we would love to figure out a way to help make a bigger impact and be more effective and more efficient so that you make even more money. So please know that's our heart in totality. But can you summarize just the video real quick and the topic, and then we'll get into the nuances of the topic after that.
Yeah. So basically, it was starting the conversation around do you have the right compensation, and calling out some things that have changed. There's no doubt values have gone up significantly over the past 5 years. Equity in America has gone up, and we're not talking like a few numbers. I mean, it's a massive increase in value, and both realtors comp and loan officers comp is tied to loan amount and purchase price. Someone made a comment, are you suggesting because values have gone up that, by the way, I think there are a lot of loan officers that can raise their comp. And there are a lot of lenders that can help their loan officers raise their comp. And I think there are a lot of realtors. So it's not just about, it's about right sizing your comp. Now, in that article, I didn't make any specific suggestions because I wanted to hear how it would be responded to. And then I'm doing some data research right now where I have a lot of lenders providing me and loan officers providing me with, what their comp is in basis points, how many loans they're closing, how many credit reports they're running, how many loans they're closing, so that we can really look at the data and draw some conclusions. But I have had enough conversations now where that was the post. Most of the comments were pretty positive, but a few people just took this assumption. They either got into channel, like which channel is better.
Yeah, that's not helpful.
And then some comments were just assuming that I'm telling the whole mortgage industry that loan officers need to lower the comp, and that is not a correct assumption. And I've got some ideas though, because some people should lower their comp. on a per loan officer basis. Some
Well, and
shouldn't.
you said right size. I love that you said that. Right size could be more. I think you're probably going to talk about you got to earn if you're going to right size it up. But why now? I remember we all remember
Oh,
margin compression 1.0 back in like 18, and then here we are in 2024. I'm guessing it's because continued 3 years of adversity, margins have been compressed. It really, you said 2 years. I would say it's probably 2.5 years of lenders not making money. I saw some comments that were probably driven by emotion and not factual, where I think sometimes loan officers think that the organization is more profitable than they are. When Q4 is about ready to wrap up, guys, and you're going to see where the dust settles, and predominantly there's not going to be a lot of profit left over. So sometimes you say a thing and you think it's true. It doesn't always mean that it is, though. So, but why now? Like, what made you
well, yeah,
come out
really,
now?
really, really, really clear. There's both lenders and loan officers are not, too many of them are not achieving their goals in a sustainable way. So whether the lender is not achieving profitability in a sustainable way to support the loan officers, and too many loan officers are not achieving their goals in a sustainable way. And I think it's also really clear that like interest rates aren't going to just go into threes, fours, and fives again. So
Mm-hmm.
while like over 50% of loans in America are 2%, 3%, or in the low fours, and when you talk to the top economists and you talk to people that predict where rates are going, the we are in a new cycle, and at the lowest, I mean the most, what do you call it? Optimistic people are like high fours. Like maybe they'll get into the high fours. Most people are predicting that we're in a marketplace going forward, at least for the next 2 to 3 years, in this cycle where rates are where they're at today, maybe a little higher than where they're at today, into the fives. And so we need to get sustainable pricing and sustainable business practices if both lenders and loan officers are going to thrive.
I
And
think
and
that's
now it's time to do it.
the first point too, and let me kind of touch on that, and I'll ask kind of like some of your takeaways already from the conversation that you started. But sustainable is the operative word. Unfortunately, if organizations can't pay their bills, they can't offer you a position to originate loans so that you can make money. And I think that's kind of been slept on in the industry for a long time, and it's imperative. And we've seen a lot of mergers and acquisitions and closures happen, and then they will continue to happen here in Q4 of 2024. But you have to have a sustainable model, and it really is, whether you know it or not, it's a team approach. I've got to work with my organization to have a sustainable model so I can continue to do this and put food on my plate and provide for my family. So that's a big takeaway from me right away. But I know you're working on this continuously, which I love. Maybe we can come back as you get more data. But right now, maybe you're halfway into it. What's your biggest takeaways? Maybe some aha moments, maybe some things that you didn't see right now in terms of where you sit with the conversation.
Yeah, so I don't know how much time we'll have because I've got a lot of data, and I'll start unpacking it for you. So first of all, for all the loan officers that are looking at it and say, "I'm telling you to lower your comp," I just want you to answer one question: Are you achieving your goals in terms of the number of loans you close and the amount of income you make? And by the way, for everybody that's like, "Yeah, I'm killing it. I'm closing the amount of loans and I'm making a sustainable amount of income to support my family. I'm not going backwards, and I'm whatever your goal is, whether it's paying off your home and being financially free, whether like if you're hitting your goals, there's a really good chance you are priced properly. But my guess is the majority of loan officers are not. You're not hitting your goals in a sustainable way. So I still want both, let's just say 90% of people who or 10% who are, and 90% to answer this next question. What is your credit report to funding conversion? And how does that compare to the peers with your model? So give me on this, like people that are an IMB in Columbus, Ohio, like you're going to have a certain amount of basis points that you're making in a certain conversion. How's your conversion? Are you in the upper 10 to 20% of people that convert credit report to funding? And by the way, if you're killing it financially and you've got a top 20% conversion rate, you're probably priced right. And there might even be some playing with that. Like, could we add a few basis points and still stay at a really high conversion? Like, I'm a for-profit entrepreneur.
Can
You
I
want to
touch
say
on
something?
that? Yeah, I mean, because I don't want to interrupt the data, and I want more data. I love it, but I want to unpack a little further. I think if you've been in the business as long as I have, 20 years, you've probably never had to worry about, app to credit report. And I would throw in VOE costs, not to get in the weeds. I'm an operator in the business, so I know VOE costs are through the roof and credit reports are through the roof. And why should I care as a loan officer my ratio? Because here's why. Again, we're talking about the viability of our organization. If 40% of your VOEs and credit reports are not attached to loan numbers and you're not closing them, yes, you could call it the cost of doing business, but it's also waste. And the more waste an organization has, the higher the margins have to be to account for that waste. And so again, teammates, loan officers, organizations have to come together and go, okay, some of this is a cost of doing business. Some of this I can sharpen up on, or I can convert and increase my ratio, my closing ratio too. So think of it that way. Like, just Google credit reporting costs. I promise you, if you haven't gotten in the weeds on this, they've skyrocketed for everybody across the nation. And VOE costs, which if you haven't worked into your data point, Dave, get some data on that, because that's wild too when it comes to ordering VOEs for somebody that's got 6 jobs and now you're $1,000 into VOE costs. So just wanted to unpack that a little further. 'Cause you make
Yeah,
a great
yeah. And I'm
point.
gonna I'm gonna plus one that. Like, I'm gonna raise you. What
I
he
love it.
said, I call and I raise you.
Raise.
And here's the raise. If you are a salesperson, you're a loan officer, your score as a quality, great value creator and loan officer is a combination of your conversion and your price exceptions. If you are among the highest conversion people with the least amount of price exceptions, and and I'm not here to say let's be a low cost leader, like be Nordstrom's,
Yes.
be be a premium player, but that will make up your score as someone that people like you. You talk to people, they trust you, they do business with you, or if you're in the top 10 to 20%, check. So for the most part now, if you're a loan officer and I'm achieving my goals, check. I'm in the top 10, 20% at a conversion and also, profitability and price exceptions, check. By the way, you guys can leave the room now. Like, your comp is good. The rest of you guys, let's stay in this. Let's stay in the hunt here.
Right. Yeah.
And by the way, do you agree with all this so far?
Oh,
Is this
100%,
resonating?
man. I love the conversation. We have to evolve as an industry, guys. We haven't even got into the cost of technology. And it does cost organizations a lot to implement really good technology. Dave's in that space. He can speak to that. And so when you implement technology, there is a cost to that. And it also, good technology takes a lot of stuff off your plate. And so if things are getting taken off your plate because of the cost of technology, that conversation needs to be had.
Yeah, and by the way, this is my message to the C-suite. This is my message to branch managers, because we all got to do it here. Is you should know which loan officers they just left the room. Like, what quartile of your loan officers that are, their profitability, they're profitable, they're sustainable, they've got their price right, the experience they're delivering to consumers is great, and their conversion proves it, their concessions prove it, and now for who's left, and it's going to be a big portion, in my opinion. And by the way, any C-suite leader that wants to run these numbers, whether you want to share the results anonymously with me, I have a number of people that are going to let me actually create case studies and not be anonymous, but I don't care. I'm trying to get smart on in a big data way where I have thousands, if not tens of thousands of loan officers that we're doing this analysis on and that we're providing the industry some best practices and thoughts. But now if you're still sitting here, is it what would happen if we improved your conversion between wherever you're at and a top 20 percenter? And if we did, would you now be achieving your goals? And if the answer is yes, well, then that's it. And by the way, just in marketing, that's product. So what is your product? That is pricing, and that is like packaging and promotion. Like those are the 4 P's that I don't care what business you're in, those are the 4 Ps to really look at your business: pricing, product, promotion. And so now let's look if that's going to get you over the hump. And that there's a big group of people that if they could go from a 50%, an under 50% quartile to a 90% on conversion, they're winning. Now it's like again, I'm Mr. Mortgage Coach. I would say, hey, show me how you're delivering price to the consumer. And if they showed me a fee worksheet, I would be like, okay, let's compare that to a mortgage coach experience: graphs, charts, mobilely optimized video, showing people how to get debt free faster. Like, there are now tens of thousands of loan officers in America that are like, they're not selling loans. They're showing people how to achieve their financial goals over time. And so I would look into that and then optimize it. And once your conversion is optimized, now you have a sustainable mortgage practice. Now we need to go and look at lead source. How are you biz dev generating opportunities to put into your funnel? But my message is, between now and the end of the year, let's get pricing right. Let's get product and packaging right. And then we can start working on the funnel. But if you don't have your product, price, and packaging right, you're just putting loans into a broken funnel.
Yeah, yeah. I mean, it's the value conversation with realtors too. That's why I started with this. All applies to our realtor partners as well. And the value, the more value you can provide, that maybe to your point, you can even charge more versus less. But
Well,
what
you
value
can.
are you truly providing?
I know loan officers that are doing it. I mean, I have the data where there are loan officers that are making, call it the price right, package right, product, are 20 basis points more profitable than
Yeah.
those who are.
Yep.
And even up to 65 basis points. And we're not talking about 2, 3 loan officers. We're talking about entire regions of 44 loan officers. We're talking big groups, 93 loan officers that are outperforming 319 loan officers because they've got their product, pricing, and packaging right.
Yeah, it's a great conversation. It gets really nuanced, and it's not an easy answer. I mean, you touched on product. We didn't even unpack product, but guys, if you haven't dug into margins with your organization or your branch manager, the product on a bond loan is different than the product on an FHA loan. It's different than a product on a jumbo loan. And some are very, very thin, and you may lose money closing one or break even, and some you might make a little bit more money. And if you're all just doing one product, I mean, we saw members at credit unions literally let go last year, and I don't think it was the right move because nobody came in and had a healthy conversation. But they were closing all one product, and because they weren't profitable loan officers, and they were cut. I think that's a travesty because nobody coached them through that. They didn't have the conversation prior to, and they probably didn't even know they were doing anything wrong. And were they even doing anything wrong? They were originating closing loans that they didn't know were not profitable. So it gets really nuanced in the conversation when it comes to product.
Well, I want to make sure that everyone listening to this goes beyond the definition of product, because the mortgage industry thinks product is, govy, conventional, jumbo, non-conforming. And I want you to start thinking about the packaging of those products, and how are you packaging, and not just from a mortgage coach perspective. There are other things that you can do with how a loan is presented to the consumer in a way that, like, the modern experience is what is the fastest, easiest way to deliver the most convenience and value to a consumer.
Yeah.
And by the way, in 2024 and 2025 and beyond, that will be powered through technology, and that will be consumed primarily on mobile devices. So I just want to make sure, as we go down this getting pricing right, we have to get packaging right.
Yeah, I think it's easy for us. I definitely do it, and it's a part of the equation. Product equals actual product. I think you're talking about product in terms of experience, overall experience, the experience being had.
In
on
all
mobile.
other industries, that's how product is viewed. I mean,
Yeah.
the mortgage industry, I think, has a shallow view of product that I want to try to expand and improve. I do believe IMBs, every channel can be profitable right now and going forward. I do believe, I mean, obviously not every loan officer can hit their goals because I think, conversion is only part of the formula. There is a certain amount of work ethic that needs to be applied. There is a certain amount of skills beyond just conversion skills that need to be adopted and used on a daily basis. But I just think it's time to go after getting pricing right, and no better time than now.
Yeah, love it. I can't wait to see the data that you continue to work on. You and I had a Moneyball conversation after your original conversation. We had the 2.0 that was completely like widespread.
By the way, we should do another one
nation.
with Jim Deitch. We should
Yes.
get Jim Deitch and Garth Graham, and let's all
it's a great
do this
idea.
together.
We could do a 3.0, but I see this as a continued version of that conversation. We can have 3.0 like you're talking about. I'd love to pull Garth in. I know he's passionate about that. I wanted to start the conversation today. I think you guys, are seeing that it's not just a takeaway. So I'm glad that, Dave, you articulated that perfectly. It can actually be the opposite of a takeaway. We'll continue the conversation. I can't wait to see your data. I'll be a part of it as much as I can.
Actually, are you subscribed yet? It's quick, easy, and free, and gives you plus 500 aura. So let's hop back into it.
Any big takeaways before we wrap up? I wanted to have a short conversation so you guys get back to your day. But what's the takeaway right now? You're a loan officer. You're like, you know what? Hills and Dave is right. They're right. What do they do next? What's the next step for that LO, that branch manager, that C-suite?
Well, first of all, I'm going to be talking more about this on LinkedIn, and then I'll be posting some of that in our Trust Engine Facebook group. So stay tuned in to the community. But I think for right now, whether you're an executive, branch manager, or loan officer, go through the exercise that we went. Like re-listen to this, take this video, maybe have a sales meeting around it. Use this as a tool for all you branch managers and regionals and it is hard, like to go to your loan officers and go, hey guys, let's talk about comp, let's get it right. Use us, leverage us, share this video with who you think would get value from it, and go through this exercise. And then I'll continue to work on building tools. Like I'd love to just have like a 1-page worksheet that takes a loan officer through a process to right size your product, your pricing, your packaging, so that we can start the new year just crushing.
Love it. Dave, you're spot on once again. We will put the LinkedIn post below. We'll go find Moneyball 2.0, the conversation we had. We'll also put that in because they tie in together perfectly. Appreciate you, man. What a great conversation. We'd love to hear your thoughts. You'll see a lot of thoughts on the LinkedIn post. We'd love to hear your thoughts here. Keep it positive. Keep it constructive. See you guys next week.
Take care, everybody.